Hello, property investors. When it comes to rental property success, one of the most important metrics to monitor is your cash flow. It's not just about owning property or collecting rent. It's about ensuring your property consistently brings in more than it costs. Analyzing rental property cash flow helps you identify real profitability, avoid financial strain, and make well-informed investment decisions. In this video, we'll walk you through how to analyze cash flow in detail. Whether you're a first-time landlord or a seasoned investor, understanding your property's financial performance is a foundation of long-term success in real estate. What is rental property cash flow? Rental property cash flow is the money left after deducting all operational and ownership expenses from your rental income. When income exceeds expenses, it results in positive cash flow. This is the goal. But if expenses outweigh income, it's a negative cash flow situation, which can be financially draining. Many landlords forget to include less obvious costs such as vacancy losses or property management fees, which leads to misleading calculations. By capturing every cost linked to ownership, you get a true picture of your property's financial performance and profitability. 2. Gross versus net cash flow. Why it matters. Don't make the mistake of relying on gross cash flow alone. It's only the total rent collected. The key figure focus on is net cash flow, which is the amount left after all expenses have been paid. For example, if you receive 80,000 Indian rupees in rent but spend 75,000 Indian rupees on mortgage, repairs, and services, your actual profit is just 5,000 Indian rupees. Analyzing net cash flow gives you the clearest insight into your rental property's actual returns and enables better investment planning and risk management. 3. Classifying fixed and variable costs. For accurate cash flow analysis, separate your costs into fixed and variable categories. Fixed expenses like mortgage, property taxes, and insurance remain constant regardless of occupancy. Variable expenses, such as repairs, utilities, and vacancy-related costs, fluctuate depending on tenant activity. By identifying which expenses are predictable and which are flexible, you can budget more efficiently and build resilience into your financial strategy, especially when navigating uncertain market conditions. For planning for vacancies and tenant turnover, even the best managed properties face vacancies. These gaps in rental income, along with turnover-related costs like cleaning, repainting, and re-advertising, can reduce your annual profits if not factored in. A good cash flow analysis includes an assumed vacancy rate, typically 5% to 10%. To create a financial buffer. This approach ensures your income estimates remain realistic and that short-term gaps don't derail your long-term returns. 5. Including property management fees in analysis. Whether you're using a professional property management company or managing on your own, there's a cost involved. Management firms typically charge between 8% and 12% of the monthly rent. These fees may reduce net cash flow, but they also add value through expert maintenance coordination, legal compliance, and tenant management. Even if you self-manage, your time and effort carry a cost. Including this operational expense gives a more honest assessment of your rental property's actual earnings. 6. Preparing for capital expenditures. CapEx. Routine maintenance is expected, but large-scale expenses, such as roof repairs or plumbing overhauls, are inevitable and costly. These long-term capital expenditures can severely impact cash flow if you're not prepared. Smart landlords allocate a portion of monthly income into a reserve fund to cover future capex. This ensures major repairs don't interrupt your financial stability and helps keep your property in optimal condition without disrupting regular operations. 7. Projecting future cash flow trends. Cash flow analysis goes beyond present-day calculations. It's also a forecasting tool. By projecting future income and expenses over 1, 5, or 10 years, you can prepare for changing market conditions, rent appreciation, tax variations, and inflation. These projections empower you to make strategic decisions about refinancing, selling, or scaling your portfolio. Thinking ahead turns your investment from reactive to proactive and lays the groundwork for sustainable rental income growth. 8. Cash flow analysis by unit for multi-family properties. If you own a multi-unit building, analyzing cash flow per unit helps identify which ones perform best. Some units may have higher repair costs or longer vacancy periods. By tracking financial data for each unit, You can implement rent adjustments, make specific upgrades, or adjust marketing strategies. This detailed approach helps you optimize your property performance and boost the overall profitability of your rental portfolio. 9 portfolio-wide cash flow comparisons. Owning multiple properties means comparing their financial outputs is crucial. Analyzing cash flow across your portfolio reveals which properties are profitable and which are underperforming. For example, a modest flat with low maintenance can outperform a larger unit with frequent vacancies. By comparing property performance side by side, you can make decisions about reinvestment, divestment, or strategy changes, ensuring that your capital works for you as efficiently as possible. 10. Embracing technology for real-time tracking. Gone are the days of manual spreadsheets. Property management software offers automated tracking of rental income, expenses, and cash flow projections. These tools reduce human error and allow you to analyze trends, categorize spending, monitor tenant payments, and generate real-time reports. Leveraging technology makes cash flow analysis more accurate, efficient, and scalable, especially as your property portfolio grows. Bonus tip: how SANGAU helps you maximize cash flow. At SANGAU, we understand that rental income is just one part of a successful investment strategy. Our professional property management services are designed to help you maximize rental profits through transparent financial tracking, detailed reporting, and proactive capital planning. We monitor every expense, track income in real time, and help landlords optimize their portfolio performance. Whether you manage one unit or several properties, SANGAU's data-driven approach ensures you're always making informed, strategic decisions that strengthen your bottom line. Thank you for watching. If this video helped you understand how to analyze and improve your rental property cash flow, be sure to like, share, and subscribe to our channel. Stay connected with SANGAU for more expert advice on property management, rental income strategies, and building long-term wealth through real estate in Bengaluru. See you in the next video.